I hope you have liked my video so far regarding using mathematical tool to look at some of the investment methods that I do myself. Okay, so today we're going to talk about a mathematical tool that I use as my investment thermometer. So just to put a disclaimer to this video, this is my way of looking at how my investment has performed. It's not like financial advice or anything, but it's just to show you how I use it as a means, okay, to objectively diagnose my own financial investment health. Okay, this is the mathematical tool that I use. You may use other things, you may use this, it's up to you. Everybody has different preference, so this is just a disclaimer of that. Okay, so for me, I would use the compound annual growth rate, okay, in short, the CAGR, to actually try to help me understand my investment health. So this is the first part, which is on the illusion of smooth returns. Okay, the reality in the market is that it actually goes up and down over the years and things like that. Of course, if I want to track it very, very closely, like year to date, like at the start of every 1st Jan or first trading day of the year or first trading day of the month or whatever, and I track it very, very closely, I can. Okay, but the thing is, it requires too much an effort to actually keep track of all those stuff. So instead of doing it on a monthly basis, yearly basis, usually I would just do the CAGR, which actually smoothen out my returns by using the model that we used to have, which is actually the compound interest formula. Then from there, I will actually try to get a number or the growth rate that is actually what we call the compounded annual growth lah. Okay, so basically it's just a simple number, good enough to help me understand whether my investment is doing well. Okay, so how do I get this CAGR? Very simple. I use my compound interest formula. Okay, so now remember our compound interest formula for future value looks like this, right? Where your R is your rate of nominal rate of growth or real rate of growth or whatever. That's up to you to decide. Okay, so what will happen now is that we will still use this formula, but I just change it a little bit. What do I mean by change it a little bit? Okay, instead of future value and present value, instead of the rate of nominal rate and things like that, okay, I actually use CP, which stands for current price of my investment, BP, which is my buy price, okay, of my particular investment, and then I just call it the rate of growth. Okay, the smoothen out one. Okay, it doesn't really matter. Okay, let's just look at this, and then I just come up with a new formula, which is CP equals to BP 1 plus R growth power T. Right? So what I'm going to do is I'm just going to make R growth the subject. So what I can do is 1 plus R growth power T equals to CP over BP, and then I take the Tth root. Okay, so this T can be in years, can be in months, it can actually be a fractional number or decimal number, it doesn't really matter. So my R growth is CP over BP power 1 over T minus 1. Okay, so this rate of growth is like I'm assuming that I have actually grow consistently compounding at this R growth rate over the time period, but it may not be true. Okay, it may not be true because there's up and downs. Some years you make money, some years you lose money, some years you will make more than another year. So this is just smoothen out, right? So this is what I have, okay, as my R growth formula, okay, for my to calculate my CAGR. Okay, so now if I have a single entry model, means at the start of Jan 2021, I bought it at $2.94. Okay, and then I don't do anything until Jan 2026, where the ES3 becomes $5. Okay, I take my number of years of investment to be 6 years. Okay, because 2021 to 2026 Jan is 6 years, right? So applying it into my formula, my R growth equals to current price divided by my buy price power 1 over t minus 1, right? Which gives us 5 over 2.94 power 1 over 6 minus 1 is 0.0925, right? So this means my money is growing at a pace of 9.25% per year. So if I were to be very precise, it is average pace. An average pace of 9.25%, which is very well, because remember our inflation is actually about 2.5 to 3%, and then my returns is actually 9.25% for this particular stock that I have been buying, right? So if I were to put this 9.25, okay, into my adjusted real rate growth with inflation, okay, to adjust for purchasing power, as what we have learned in the first and second video, okay, I put in the investment data. Oh, sorry, this shouldn't be have a H. Okay, so it will be 0.059819, which tells me, okay, the real rate of growth on average across the 6 years, okay, is about 5.98%, which is good. Means you know that your money is growing, your wealth is growing, your purchasing power is growing, right? But to calculate the exact returns, okay, what you can do is, instead of doing this as a smoothen out CAGR, you can actually use year-to-year data and put it in. But like I say, it's not going to be very feasible if you don't buy it at the start of the year, or you don't buy it at the start of the month. You do a little bit of timing of the market, like when you get your bonus, then you start buying it, or when you feel like it dropped enough for you to DCA in, then you buy it. Then it's very difficult to get this very exact number of, like, when it grows, the CAGR comes into play. So if you also do not keep tracking of the inflation data, okay, or the price data, then actually it's also quite difficult for you to get a very good number. So what you can actually do is, what I actually do is, okay, I will just do a estimated CAGR using another method which I think works for me. Okay, so for example, okay, every year I invest $1,000 in ES3 at the start of the year or whatever. Okay, so you will see in 2017, at the start of the year is $3.11. Okay, and then I invest 1,000, I get 321.54 units. 2028 it went up $3.58, I get this much. $3.25 in 2019, I get this much, and so on. So you see, the number of units varies, the buying price also varies, but the amount that I have always been putting in is always 1,000. Okay, so what happens is, how do I actually modify my formula to reflect the reality of putting in money at different times and at different prices? Okay, so what I actually do is, I just need to calculate the average buy price of my ES3. Yes, it is a very rough gauge, but it's fine because I don't need to have a very precise number. I just need to know the smoothen out rate, so that at least I know I'm under the water or above the water. Okay, so what do? I calibrate this formula accordingly. Okay, instead of using current price equals to buy price 1 plus R growth power T. Okay, I just need to modify it a little bit, okay, to take into account that I'm actually using an average price. So I use the current price, okay, so I modify a bit to become buy price average 1 plus R growth power T, right? So I change it in such a way to account for this $3.42. So now let's do this again. Okay, so my current price is still $5. My average buy price is 3.42. I have invested for a period of 10 years. Okay, when I make R growth the subject, I get this 1 over 10 minus 1, which gives me 0.03871. Now, what does this mean? This means my R nominal, R growth, okay, or I can take it as R nominal, is growing at 3.87% per year for these 10 years, average out, okay, which is a very rough gauge. But you can see that when I use this method, I'm still above the inflation rate, right? Which tells me that I'm doing well. So if you look at this wealth growth again, remember I have my inflation, I also have my wealth growth, right? So what happens is that we learned that the R real is actually R nominal minus R inflation divided by 1 plus R inflation. So this tells us that my R real, if I plug in the numbers over 1 plus 0.03, I will get 0.008456, which means in terms of percentage, it is 0.847%. Now, this looks a bit depressing because I'm telling myself that my real rate of growth of my wealth is only 0.8% per year after I adjust it for inflation. But on the other hand, it's also telling me that, okay, I did not lose my purchasing power. I actually kept up with inflation, and my money grows a little bit, not too much, but it's fine, right? Because as long as my rate of growth is real rate of growth is higher than 0, I'm happy enough, right? So let's take a look at this diagnostic matrix of timing versus consistency. Okay, if I have a one lump sum single entry model where I put everything in one time in 2021 and I just wait, yes, over 6 years is a fixed buy price. I did not increase my number of units. I did not increase my money invested. My nominal result is 9.25%. But if I do a continuous entry model where I do averaging over 10 years, okay, okay, I'm sorry that this data is 6 and this data is 10, but for illustration purpose, you get what I mean. Okay, my nominal result becomes lower than what I have in the lump sum, but that is actually fine, because that's the thing about investing. Okay, you want to consistently with discipline invest in the market every year, right? So which one do you prefer? Okay, I mean, you want to do single entry or you want to do continuous entry model, I also have many different ways to do it. I can do it in the dollar cost averaging, I can do it in a lump sum, I can do it ad hoc, but still sort of averaging. Okay, in the next few videos, I will also explain what does dollar cost averaging means, and we'll also look at some mathematics of dollar cost averaging, right? So making that explicit is that market timing, okay, drastically alters your nominal CAGR, okay, compared to the continuous cyclic annualistic accumulation, because you can see, of course, if you put one lump sum in, yes, you may seem like your nominal rate is high, but there's a risk. Why? Because if I enter at a market high, okay, and it actually after 10 years it actually goes down, okay, you may be under the water, which I may not want it to happen, because I won't be happy if I lose money. Okay, but if you buy at the market low and it recovered and it doubled, of course you'll be happy, right? So the continuous entry model, through averaging, yes, nominal rate may not be great, but at least you know you are not tied down by a single fixed price. All right, so how do I actually use this as my thermometer, as I have said? Okay, so my surface level readout will be, okay, my R nominal is 3.87%. That's very superficial. 3.87%, fine, more than zero, I'm happy. But I want to look at my purchasing power readout, because if I adjust it with inflation and I take it as 3%, all right, 0.84%, I am still growing my money, I preserve my purchase power, good enough for me. Okay, so that is what I want to share with you, my mathematical tool that I had used to do it as a thermometer for my investment health. Okay, so you can see, if my investment, the particular investment that I buy, has a CAGR less than the investment rate, I will actually treat that as a not so good investment. Yes, my money is growing, but I don't preserve my purchasing power. Zone 2, CAGR is almost the inflation or the benchmark of the market data. Fine, I can live with it. I maintain my health. My strategy is reasonable. Of course, if I have my CAGR more than the inflation or whatever benchmark market data has, then good. Okay, my wealth is growing and I'm happy with that. So of course, that is also this CAGR is also how I check whether I should sell something in my portfolio, or I need to add in more in my portfolio and things like that. I'm not going to go into the specifics of that, because everybody has different way of thinking. Okay, so the three points that I want to make through this video is, okay, you deploy the thermometer. Okay, I deploy the thermometer using CAGR as my baseline metric to cut through market noise and smooth out volatile returns, especially in the tech market. Okay, it tells me the real truth of whether my money is growing, whether I am maintaining my purchasing power, and so on. And then it helps me to answer the question of whether I should put in more money into that particular investment. The last thing is that this is governed by data. Okay, data don't tell lies. I mean, you see the price go up, you see the price go down, right? And whatever that you get from this CAGR, okay, is very objective. Okay, so that's all for today's sharing. Okay, if you like my videos, please like, subscribe, and share. If you have any questions or other types of problems in your daily life that you would like me to share and see how I use mathematics to solve them, you can also comment, okay, and I will try and reply to your messages. Thank you and goodbye.